All right. So you sent over some really interesting stuff for us to, dig into today.
Yeah.
Looking at potential investment opportunities.
Yeah.
In this kind of, current market.
Yeah.
And it couldn't be more relevant right now. The Motley Fool article you flagged for us really highlights the fact that the S&P 500, just had its roughest month since like way back in 2022. Took almost a 6% hit just in March.
Yeah, that's right. And I think, if we dig into the article a little bit, we can see a lot of the usual suspects, right? We've got, ongoing worries about trade, noticeable dip in consumer confidence, some real pressure on how stocks are valued. And then, of course, the ever-present issue of inflation kind of proving stickier than a lot of folks anticipated.
Yeah.
It really creates a climate where investors are understandably a little bit cautious right now.
Absolutely. But, this deep dive isn't about kind of getting bogged down in the downturn. The really compelling angle of this Motley Fool piece, it's called 2 Monster Stocks to Hold for the Next 5 Years. Came out just yesterday, April 4th, 2025.
Right.
Is that these very market pullbacks can often reveal some really attractive buying opportunities.
Right.
And that's what we're going to be focusing on today, dissecting the 2 specific stocks that they have pinpointed as having potentially massive upside over the next 5 years, even with all these current headwinds blowing.
So, our mission, should we choose to accept it, is to really get under the hood of, why these 2 companies are being singled out.
Yeah.
We'll explore their core strengths, the rationale behind their long-term potential, and we'll also touch on some of the potential bumps in the road, or factors that could influence their journey.
Okay, so let's unpack the first one.
Okay.
The first monster stock that they've put on our radar here is Taiwan Semiconductor Manufacturing.
Okay.
Or TSM by its ticker.
Gotcha.
Now, for anyone tuning in who might not, live and breathe semiconductors,
right,
this company is a true titan. They are the planet's biggest contract chip manufacturer.
Exactly. And that title, largest contract chip manufacturer, I think really speaks volumes about their kind of pivotal role in the tech ecosystem.
Yeah.
Unlike companies that design and sell their own chips, TSMC focuses solely on manufacturing the designs of others,
right,
which makes them an absolutely indispensable partner to a huge array of tech giants.
You get it. The article really nails it. They call them a linchpin in the global economy.
Yeah.
And it doesn't feel like hyperbole when you look at their client roster.
Yeah.
I mean, we're talking about the powerhouses.
Yeah.
Apple, Nvidia, Advanced Micro Devices, Broadcom.
Yep.
Some of the most innovative and influential tech companies out there.
It's almost breathtaking when you see the caliber of companies that are relying on TSMC, right?
Yeah.
You're talking about the very engines of innovation in the tech world.
Absolutely.
And, what's fascinating here is how TSMC has positioned itself to capitalize on some really powerful trends.
Yeah.
Most notably, the explosion in artificial intelligence, or AI, right? The insatiable demand for advanced computing power that AI requires translates directly into a massive need for the kind of sophisticated chips that TSMC excels at producing.
Yeah.
And this has quite predictably fueled significant growth in their sales and profits.
And it seems like they're not just a player in the advanced chip game, they're practically the entire league.
Yeah.
The article points out that they command around 90% of the market share.
Wow.
In manufacturing these cutting-edge chips. I mean, that is a truly staggering figure.
It is.
And it really underscores their dominance in this AI-fueled era.
It truly is. That level of market share doesn't just happen. It creates a formidable barrier for anyone trying to compete. Building the kind of ultra-precise manufacturing capabilities and deep technical expertise that TSMC possesses requires colossal investment and years of relentless refinement. So this near monopoly position, gives TSMC significant leverage in negotiating contracts and potentially shaping the future of chip technology. So their leadership looks pretty entrenched for the foreseeable future.
Now, despite all this seemingly unstoppable momentum, the article does remind us that, the semiconductor industry is inherently cyclical.
Right.
And TSMC stock has experienced a recent downturn. It's down about 26% from its peak as of the end of March.
Okay.
So the big question is, why does the Motley Fool see this as a silver lining?
Well, I think this is where the old investment adage, buy low, sell high, comes into play, right?
Right.
The article interprets this recent dip not as a red flag signaling fundamental problems at TSMC,
right,
but more as a consequence of broader market anxieties and, the natural ebbs and flows of the semiconductor sector. For investors with a long-term horizon, these kinds of pullbacks can represent a valuable opportunity to acquire shares
Yeah.
in a fundamentally strong company at a more attractive valuation.
And on that point, they highlight TSMC's current price-to-earnings ratio, which is hovering around 24.3.
Okay.
The article makes the case that this is roughly in line with the S&P 500's average PE, even though TSMC's growth prospects are arguably significantly brighter.
Interesting.
A PE of 24.3 suggests investors are currently paying about 24 times the company's annual earnings per share for the stock.
Mm-hmm.
For a company with TSMC's growth potential, some analysts might argue this is quite reasonable, even undervalued.
Exactly. Typically, a company with superior growth potential might trade at a premium to the broader market average.
Right.
So the fact that TSMC's PE is currently on par with the S&P 500, especially when you consider its pivotal role in the rapidly expanding AI landscape, suggests that this recent stock correction might have created a bit of a disconnect between its present valuation and its likely future earnings power.
There's always one big elephant in the room when TSMC comes up.
Sure.
And that's its location in Taiwan and the geopolitical risks associated with potential Chinese aggression. The article does address these investor concerns. So what's their take?
Well, they emphasize the company's proactive efforts to diversify its manufacturing footprint on a global scale.
Okay.
And this isn't just lip service. They are making substantial investments in establishing facilities outside of Taiwan.
Right.
The article specifically mentions the significant financial incentives they've received through the U.S. CHIPS Act, which is designed to encourage domestic semiconductor production.
And they also point to that massive $100 billion investment in the U.S. that the company announced at the White House just last month.
Yeah.
I mean, that's a pretty concrete commitment. To expanding their operations beyond Taiwan's borders.
It is indeed. And while, it doesn't eliminate geopolitical risks entirely, this diversification strategy does serve to mitigate them to a certain degree and clearly demonstrates that the company is acutely aware of these concerns and is taking tangible steps to address them.
The article also shines a light on TSMC's robust revenue growth in the fourth quarter, which clocked in at a healthy 39%. That certainly doesn't paint a picture of a company facing major headwinds.
No, it doesn't. While the pace of growth might moderate if the global economy experiences a slowdown, as the article acknowledges, the underlying long-term drivers, particularly those fueled by AI, appear to be incredibly strong. These aren't just fleeting trends, they represent a fundamental transformation in computing and technology. It's a bit like the seasons. There are periods of strong growth and periods of cooling off, but the underlying long-term demand for technology continues to rise.
So to wrap up our discussion on TSMC, the Motley Fool's perspective seems quite clear. They view it as a compelling no-brainer stock to hold for the next 5 years.
Right.
Primarily due to its dominant position in a massive and expanding industry, combined with what they perceive as an attractive entry point following the recent stock decline.
That's a very accurate summary.
Yeah.
They're essentially arguing that the company's foundational strengths and its critical role in driving key technological advancements outweigh the current market uncertainties and the geopolitical considerations.
Yeah.
Especially given the proactive measures TSMC is undertaking to mitigate those risks.
All right, let's shift gears and turn our attention to the second monster stock highlighted in the article, the Trade Desk, trading under the ticker TTD.
Got it.
Now, this is a company operating in a completely different arena, the world of ad tech.
Yeah.
The article describes them as the leading demand-side platform, or DSP.
For our listeners who might not be deeply immersed in the intricacies of digital advertising, a demand-side platform is essentially a sophisticated software tool that allows advertisers to automatically bid on and purchase ad space across the internet using data to target specific audiences much more precisely than traditional methods. Think of it as a technology hub that empowers advertisers to reach their desired consumers efficiently across a wide range of digital channels. The Trade Desk is a dominant player in this space, helping advertisers optimize their campaigns and achieve their marketing goals.
Now, the article points out that the Trade Desk's stock took a significant tumble, a real nosedive, after its Q4 earnings report in February, because they actually fell short of their revenue guidance. And apparently, this was an unusual event, the first time they'd missed the mark as a publicly traded company.
Really?
That sounds like it rattled the market.
It certainly caught the market off guard, and the stock responded sharply, as you noted.
Yeah.
The CEO, Jeff Green, attributed the revenue shortfall primarily to internal errors, rather than broader market headwinds or increased competition, however. The article also astutely observes that the trade desk's stock was likely trading at a very high valuation,
Right.
effectively priced for perfection in the lead-up to that report, meaning investors had extremely high expectations baked in.
So even if the revenue miss was attributed to internal factors, as the CEO suggested, the elevated expectations meant the market was less forgiving of any missteps.
Precisely when a high-growth stock like the trade desk stumbles, even if the stumble is perceived as temporary or self-inflicted, investors can become nervous and reassess its lofty valuation.
Yeah.
This often triggers a significant correction in the stock price,
Right.
which is exactly what we witnessed in this case.
And the correction was substantial. The article mentions the stock is down by a significant 60% at this point.
Wow.
That's a dramatic drop. Yet, once again, the Motley Fool sees a potential opportunity here.
Okay.
Even labeling the stock a steal at its current price, what's fueling this optimism?
Well, despite the disappointing Q4 revenue guidance, the article reminds us that the trade desk still delivered respectable revenue growth in that quarter, with revenue increasing by 22% to $741 million. While it didn't meet the ambitious expectations, that's still a significant growth rate in the context of the broader economy.
They also highlight the inherently cyclical nature of the advertising industry as a whole,
Right.
pointing out that the trade desk actually demonstrated strong performance in 2022.
Yeah.
Even when many other advertising-related companies were facing headwinds, that suggests a certain level of resilience or a distinct competitive edge.
That's a critical observation. Their proven ability to navigate industry-wide challenges in the past provides some reassurance that the recent revenue shortfall might indeed be an isolated incident, as the CEO indicated,
Right.
rather than the start of a more concerning long-term trend. However, as the article wisely cautions, another earnest report will likely be necessary to provide greater clarity and confirm this narrative.
Now let's talk about how the market is currently valuing the trade desk.
Sure.
The article mentions its adjusted price-to-earnings ratio is currently around 33.
Okay.
And they consider that a good price to pay for a company that is a leader in its sector. Why that assessment, especially after such a significant stock decline?
Even after the substantial sell-off, a PE of 33 isn't necessarily considered cheap in absolute terms. However, for a company that is still demonstrating solid growth and holds a dominant position in a dynamic and expanding market like digital advertising, it could be viewed as reasonable, particularly when compared to its historical valuation multiples. The industry leader status is key here, as it often implies a strong competitive position and pricing power within the market.
And looking towards the future, the article highlights significant growth opportunities for the trade desk in areas like artificial intelligence and the rapidly growing realm of connected TV.
Right.
Can you elaborate on how they might capitalize on these trends?
Absolutely. AI is increasingly being integrated into ad tech to enhance targeting capabilities, personalize ad experiences, and improve the overall effectiveness of advertising campaigns. As a leading DSP with sophisticated data analytics capabilities, the trade desk is well positioned to leverage these AI advancements to offer more value to advertisers. Similarly, the explosive growth of connected TV-think streaming services on smart televisions represents a significant new frontier for digital advertising, and the trade desk is actively developing and expanding its capabilities to help advertisers reach audiences in this increasingly important channel. These long-term trends suggest continued substantial growth potential for the company. Their focus on unbiased programmatic buying could give them an edge as advertisers seek transparent and effective ways to reach cord cutters.
So the Motley Fool's rationale for being optimistic about the trade desk seems to hinge on the belief that the Q4 earnings miss was a temporary setback, and that the company's fundamental strengths, its leadership in the ad tech space, and the significant growth opportunities in emerging areas like AI and connected TV make it a compelling investment at its current lower valuation. They see its established track record and the current price point as making it a good bet to outperform over the next 5 years.
That's a very concise and accurate way to summarize their argument.
Yeah.
They're essentially suggesting that the market may have overreacted to the recent news, creating a potential opportunity to invest in a high-quality company with strong long-term prospects at a discounted price. Of course, it's important to remember that, market downturns can sometimes signal deeper issues. However, in the trade desk's case, the article makes a strong argument that this dip is more about a temporary setback in revenue guidance than a fundamental flaw in their business model.
So to recap our deep dive into this Motley Fool article, we've examined two companies they've identified as potential monster stocks to hold over the next 5 years, even amidst the current market uncertainty. First, we delved into Taiwan Semiconductor, a crucial and dominant player in the global chip market, poised to benefit significantly from the ongoing AI boom, with its recent stock sell-off potentially offering an attractive entry point for investors.
And second, we explored the Trade Desk, the leading demand-side platform in the ad tech industry. Despite a recent stumble with their revenue guidance that triggered a significant stock decline, the article contends that their core business remains robust with substantial growth opportunities on the horizon in areas like artificial intelligence and connected TV. Potentially making its current valuation highly appealing for those with a long-term investment perspective.
It's crucial to remember, as always, that these insights are derived directly from the article you shared with us.
Absolutely.
Reflecting one expert's analysis of navigating the current market landscape. As with any investment decision, there are inherent risks and uncertainties that need to be carefully considered.
Absolutely. This deep dive provides a valuable overview of the arguments presented in the source material. However, it is essential for you, the listener, to conduct your own thorough and independent research and to carefully consider your individual investment objectives, risk tolerance, and financial situation before making any investment decisions based on the information discussed today.
And on that note, here's a final thought for you to consider. Given the various factors we've explored today, the cyclical nature of both the semiconductor and advertising industries, the broader impact of global economic conditions, and the specific challenges and opportunities facing TSMC and the trade desk, what are some additional elements beyond what we've discussed that you might want to research or consider before making any investment decisions regarding these specific companies or the broader market trends they operate within? It's always about continuing to learn and expanding your understanding of the complexities involved.
Absolutely.
Thanks for joining us for this deep dive.
Of course.
We'll catch you next time.
Looking forward to it.